Hey everyone, welcome in to another daily editorial here on the KE Report, chatting with Craig Hemke, and we're going to be talking gold over 2,500 as we are recording. We're going to also ask about silver, when that will start picking up some more steam, as we have that gold-silver ratio right around 90 right now, and recap some more M&A in the precious metals sector. Craig is the founder and editor of TF Metals Report, which we will link to in the show notes. Craig, gold, as we're recording this later in the day on Monday, over 2,500. It's a strong move today in the gold price. We're seeing actually a number of commodities do quite well today. Copper even up, and crude. Look, there's a lot of green on the screen when it comes to commodities, but let's focus on gold, as it's been knocking on this $2,500 door, and some of the recent dips have been quite shallow through July and even through August. This is a good looking chart, even the drivers behind it being some geopolitical issues, but I think just more bigger picture, the gold price doing well, investors putting some more money into gold. What's your takeaway here, Craig, with gold over 2,500?
The first thing I think about, Corey, is a theme that the three of us have discussed so many times over the years. And it's, what will it take to get, we just kind of broadly call it the generalist, to get excited about the metals and actually consider it an attractive asset class, be it the mining shares or the metals themselves, whatever. And a lot of what we can discuss today maybe applies to that. And we can start with gold. It's always frustrating to be in a trading range, and gold has been in one now for almost 4 months. You call a bull flag, a consolidation range, whatever. But when you're in a range and when it persists for a long period of time, then the breakout of said range is noticed by many people. Most recently, gold traded below $2,000 pretty much for 3.5 years, right? From 2020 to maybe mid 2020 to early 2024. And then when it broke out, it got everybody's attention, and it put on $100 the next week, and then another $250 in the next 5 weeks. And so here we are sitting again, working toward the top of this range. We're now, if you count the first move up back in April to about 2,500, this is the 5th time we've been up here. Hopefully no one out there is going, oh my God, it's the dreaded quintuple top, because it's not. It's just a trading range. So, but when you sit in here for 4 months, everybody's watching, you get a lot of, whoever is short might have some buy stops in there. If price gets above, what's the high, 25.22 or something like that in the December contract, you put your price stop $10 above there, and you say, okay, if I'm short, let's put a buy stop in here. I don't want to, get creamed if we put on $100. So you get buy stops in there, so you get short covering. You also get people that then momentum chase because you got new all-time highs, that sort of thing. So we're very close to that. I don't know if it'll be the quintuple top, and then the 6th attempt will be the one that breaks out, but it looks good. I posted back in my Friday podcast last week. If you look at the chart, and sometimes in periods like this with the carry trade and the war in the Middle East and all that kind of stuff, charts aren't overly helpful. But if you look at the chart, gold came down back on Monday the 5th, traded down to, I think, 2404, briefly below its 50-day moving average, but it rebounded. And then it continued to use the 50-day as support all the way through Thursday. And then it shot higher on Friday, confirming that 50-day as support, but then also back above the really short-term 20-day. At that point, I thought, like I said back on Friday, I thought, okay, we're probably going back to the top again. And now here we are, kind of geopolitically driven, obviously, too. But here we are, and now the only question is this the time to finally break out?
Well, Craig, maybe the 5th or 6th time is the charm, but to your point, a lot of these levels, and we can look back in history at different levels that gold had to knock its head on heaven's door before it finally broke through. After a second or third or fourth or fifth attempt, eventually pricing does break that way. So there really aren't quintuple tops, but it's a solid chart any way you look at it. But when you contrast gold with silver, not the same kind of chart. Silver has struggled a lot more than gold is getting that safe haven bid for the geopolitics. It's getting the central bank bid, and it's getting the monetary bid because of the Fed cycle and other central banks starting to cut in anticipation of that. Has gold already priced all that in and maybe silver has to catch up, or is gold eventually going to drag silver even higher? How are you looking at silver relating to gold?
Your question, Shad, reminds me of the discussion we were having back in February and in March when gold was breaking out then in March and moving above 2100 and 2200, and silver was just kind of laying there around 24, maybe 24.50, and everybody's like, geez, how long can this go? And I remember we talked about the gold silver ratio, and like, if gold goes to 2300, I don't think silver's staying at 23 because its ratio's not going to 100, that sort of thing. And eventually silver took off beginning on about March the 31st, April 1st, and then just shot higher. So if gold does keep going up, and there's a lot of, again, we're talking technical analysis and Fibonacci numbers and Fibonacci extensions and all that kind of stuff. There's a lot of things that point to about 2650-ish, maybe as your next target for gold, which isn't, again, you think, God, that's such a big number, but it's $125 above the current level, which is like 5%. So it's not outrageous to think that. And if that's the case, then yeah, silver's probably going to catch a bid and rush forward again. The hard part about silver, and I think we might have spoken about this last week, I think of it as kind of like a teeter-totter, with gold sitting on one end of the teeter-totter and copper sitting on the other, and silver's kind of the pivot in the middle. And if you can get both gold and copper to go up at the same time, well, then silver is going to have a heyday. But if gold's going up and copper is going down, then silver kind of sits in the middle. And that's kind of what has happened here. Gold's doing great, but copper's about 20% down from its May high. Silver had to hang in there for about as long as it could, but by last week, it was down 20% from its May high. It's come up a little bit now, and it's fighting pretty stout resistance at 28, pretty important resistance now back at 28. And I think that'll be the level for people to watch as we go through this week and into the weekly close. Can it get back above 28? Heck, in a rally, can it get back above 29? But first things first, let's see if we can get back above 28. That's a key level for silver.
Talking to this rally in gold and how it could very much be a defensive play, I'm sure you read some of these articles at the tail end of last week that hedge funds have moved the most bearish that they have been on commodities broadly since 2011. They've increased their net short position by almost 153,000 futures and options across 20 different raw materials markets. Maybe that's why we have seen the weakness in a lot of the other commodities outside of gold. What have you seen in some of the COT reports and the positioning of some of the smart money?
Wasn't that a great chart? Maybe you can, if you can find it, Corey, you can post it. It was in Bloomberg chart, or maybe it was Reuters, one or the other. And just in the last 10 years, the only two other times that across a basket of commodities, and I don't think it said what 20 there were, it was 20 commodities. I mean, we can assume maybe gold, but silver and copper and the other metals and the grains and the softs, and all that jazz. Anyway, hedge funds collectively in the aggregate were net short. And the only other two times in the last 2 years were the beginning of 2016 and the beginning of 2019. And I think anybody that's a precious metals fan would go, oh yeah, gee, 2016, the first 8 months of 2016 were pretty good. And obviously 2019 all the way into early 2020 and into the summer of 2020 was a huge rally too. So that's a really good contrarian signal. And I'm really glad you brought it up. Right now, you look at like the positioning in gold, where you mentioned the commitment of traders, fine. It's back to where it was in early July, which is also back to where it was in April. And so it's like, yeah, hey, we rallied in those periods from these levels of large speculator and hedge funds and the commercial banks and the like. And so gold's not a problem. My sole concern with silver is really small, almost historically small, speculator short position. That's often kind of I remember Ted Butler used to call it rocket fuel. You start getting short covering and you have these dollar days. And so because that is so small, one of the things I've done since I've had TF Metals Report, I've been going on 15 years. So I thought, how do you measure the size of the large speculator position relative to open interest? And I thought, well, maybe you just look at a net number and a ratio. So when you get the legacy report of the commitment of traders, and they just show large speculator, okay, now without breaking it down and getting into the weeds, just the large speculator number. The report from last Friday, the large specs were long, a little over 64,000 contracts, but they were short a little over 15,000. So if you divide the long number by the short number, you get a ratio of about 4.2 to 1. Now, like I said, I've been tracking this for 14 or 15 years. Anything under 3, I get down close to 2 to 1. You're like 60,000 longs but 30,000 shorts. That's a good number for a rally. That's really good. You get closer to 1, you're really in good shape. You get over 3 and you get up closer to 4, that's pretty heavy. I think the highest I've ever seen it was 6 to 1 early in 2017. So that's the one thing that I'm glad you brought up the cotton, because that's the one thing that kind of tempers my enthusiasm a little bit. I wish the funds were a little less long and a little more short. That would make me feel a little more confident that we had some immediate upside.
Well, Craig, let me give you a little more enthusiasm, but we'll shift over to the to the gold mining stocks. We had big news today on a takeover in the sector that's going to get a lot of eyeballs, and that's Goldfields, one of the majors, taking over Osisko Mining for a 55% premium to its 20-day volume-weighted average price. So really nice to see the high premium, really nice to see a project that's a developer that's been on the vine for a long time get nabbed. And it's also spiked the punch bowl with some other companies. Right next door at Bonterra, it's up 43% today. Skeena Resources, which has a solid development project, up 26% today. We've seen some other stocks popping on the news. So is this a potential where maybe some generalists, speaking of that proverbial general, start noticing this takeover bid, or at least people in the sector start noticing that the ounces in the ground are getting revalued higher, and that could, in sympathy, lift some of the other boats?
Yeah, and that's the thing. That's that generalist idea. If we can get the stockbroker in Vancouver to walk down the hall, like I got my friend Bob Thompson that works for Raymond James in Vancouver, and I always ask him, I said, anybody asking you for names, Bob? And he's like, nope, not this week. And that's like my generalist barometer, right? If you get the other guys in the office coming down the hall and going, hey, this sector's perking up, but you got any names I could look at? And then you get this flow of funds in that actually outweighs all of the shorts and the predatory shorts that are out there, particularly in the smaller issues. So we got to get them excited. And this is the kind of thing that does get the generalist excited because, as you mentioned, Shad, I mean, a 55% premium. Okay, that works for a little overnight gain for those shareholders, from Friday versus Monday. And then you start looking around and then you go, well, no, wait a second. It's not just Goldfields that is generating a lot of cash flow at $2,400 gold. You got all the other big players and even some mid-tier players that are making a bunch of cash. And what are they going to do with it? Are they going to try to plow it into their own? They're going to buy some others and expand because they can do the math on this stuff too. And so that type of M&A, especially when we're not talking like a take under or just a merger, but actual true M&A where one company's buying another and paying in cash a hefty premium, that's an eye opener. And I don't know, the phrase that comes to mind is this kind of the rising tide lifts all boats. But on Monday, you look at the move in the index, like the GDX or the HUI index, and you can see, yeah, you know what? There's a lot of boats going up on this news. That's for sure.
Craig, why aren't we seeing higher volume just in something like GDX or even in some of the majors? We've seen a little bit of an increase in some of the major stocks, but when we talk about generalists, likelihood is generalists would move into some of these ETFs. And GDX, we have volume that we haven't seen since 2013.
Yeah, and again, that just kind of makes that point. It seems like about every 90 days it comes up in our talks about the old Grant Williams presentation that he called Nobody Cares. And anybody listen to us today, just go to YouTube and type in Grant Williams Nobody Cares, and you'll see it. And it's this great presentation he started giving in late 2015 and early in 2016. Timing couldn't have been better. I mean, the Hui bottomed at 99 in January of 2016, then it went like to 280 by August. But what he lays out in that, and our data that are still pretty accurate and pretty relevant, haven't changed much about the amount of global assets that are dedicated to the precious metals and to the sector in general. And it's less than 1%. And you think, and we're talking trillions and trillions of investable dollars. And it's like, nobody cares. Nobody even thinks to put it into the GDX. That's why that volume is so low. Nobody even thinks to look at the mining shares. Now, that's part of that's growth and value and history, obviously, of the sector as well. But when we get to a point where people start thinking, yeah, you know what, it might be smart to own some gold. And the companies that get it out of the ground, boy, it won't take a lot of money, relatively speaking, to move into the sector. I remember last Monday, the 5th, when the carry trade was being unwound and everybody was freaking out. I remember reading that day that the Magnificent Seven, those 7 stocks, had lost a cumulative like $1.4 trillion or something like that in market. It was something outrageous. And I'm like, oh my God, think if that $1.4 trillion had gone into our sector. So that's the kind of numbers we're talking about. And obviously it hadn't happened yet, which for people listening to us is equal parts frustration and opportunity, right? Because train hasn't left the station. Hey, there's another cliche for you. How many more can I come up with?
Well, Craig, I'll give you one more chance here when we talk about the economic data to come up with yet another cliche, but we'll see if the rubber meets the road on this one. Where are you looking at for the gold price to move in relation to economic data? Has the rate cutting cycle already been front run and priced in? Is there anything else on your radar that you think can keep the momentum going in the precious metal sector?
Well, here we go with a week that is going to be pretty interesting. We're recording this late Monday. If you're listening to this on Tuesday already, today, this is Tuesday the 13th, you've probably already seen the producer price index. That came out at, or if you're listening to it before 8:30 Eastern, it's coming out at 8:30 Eastern. That's going to move things, but not as much as the consumer price index, the CPI, that then is coming out on Wednesday. A whole bunch. Wednesday's a very busy economic news day. And so there's all kinds of other volatility. Again, it's been hard to read a little bit with the CPI lately because you think, okay, low inflation, bond market's going to rally, and maybe the Fed will cut. But then does that mean the economy is slowing? And so there's less demand for things like copper and silver. And so it's a little bit hard to read or anticipate the reaction in those as of late. But nonetheless, those are going to move things out regardless of what's going on geopolitically as we go through this week. And then guess what? It's that time of year again for the Jackson Hole down, where all the central bankers converge on Jackson Hole, Wyoming in about 2 weeks. Powell will be there. He will give a big old keynote speech. And everybody will be watching and listening and see if he's indicating and confirming that a rate cut is coming in September. Right now, we're pricing in 100% chance of a rate cut in September. It's just a question of whether it's 25 or 50 basis points. So any waffling on that would have a detrimental impact on the gold price, I would think. So there's a lot of stuff still coming, even though it's August. A lot of European traders on holiday. A lot of American traders trying to get out to the Hamptons one last time before we get to Labor Day. Usually get the summer doldrums and the dog days, but there's no shortage of stuff going on here over the next 3 weeks. So for everybody listening, I'd suggest you don't quite tune out right now and you pay close attention instead.
Oh, this summer's been so interesting. A lot of volatility and a lot of good moves in a number of different areas, especially the precious metals and even a lot of the stocks too, but it hasn't been simply that rising tide lifting all boats, especially when it comes to those juniors. A lot for us to keep watching and a lot for us to keep looking at, as you said, Craig. But always great chatting with you, especially on a day like today when there is a lot to discuss. Craig, thanks for your time. We'll chat again next week.